Hey everyone, I'm Ella, a financial blogger specializing in global finance. In 5 minutes daily, I'll help you cut through market noise and spot solid investment paths. Been feeling anxious opening your trading app lately? US stocks falling, bond market crashing, gold and silver surging. Is the September curse really hitting? Today, I'll skip jargon and break down 3 key things. If this stock bond sell-off will hurt your wallet, which assets protect your money, and whether to sell or buy the dip next. No fluff. Don't click away early. Let's get to the market. Yesterday, we talked about early global bond volatility, and the market hit back harder. The S&P 500 fell nearly 45 points in a day. Nasdaq dropped over 175 points, and European stocks slid across the board. Worse, long-term government bond yields in the UK, Germany, France, and Japan all hit 10-plus-year highs. Global markets are trapped in panic, and it's all happening in September, the most feared month. Many know the September curse means U.S. stocks often drop more than rise in September, but few notice bonds are riskier then. Data over the past decade, global 10-plus-year government bonds have a median 2% drop in September, the worst month of the year. In short, whether you hold the U.S. stocks or bonds, stay alert. I mentioned gold, silver surges are money-fleeing bond risks. But we need to dig deeper. How far will this bond shock spread? Only bondholders get hurt, or is it a storm sweeping stocks, forex, and commodities? I'll break this into 4 parts. All affect your money, so listen closely. Why did the bond market crash? 3 critical reasons. If you see yields surging and are confused, here's the simple version. Higher yields equals lower bond prices. Investors worldwide are selling bonds frantically. Why? 3 core reasons. 1. Out-of-control government debt. Major economies borrowed heavily for COVID relief, energy subsidies, and industrial investment in recent years. Debt is sky high. The UK Labour government needs £20 to 5B to fill its budget gap, so it's issuing more bonds. France faces a parliamentary confidence vote. A political vacuum would scare off bond buyers. The US has chronic deficits, relied on tariffs for revenue, but a court just ruled some Trump tariffs illegal. Investors worried about US debt repayment. To bond oversupply, bond prices depend on supply and demand. Governments are issuing tons of bonds, but investors won't buy, with high rates and risks. Gold, silver are safer. More sellers than buyers equals falling bond prices. 3. Fed rate cut uncertainty. The market expects a September Fed rate cut, but it's reactive, forced by high deficits and a strained financial system. Shorter-term rates may drop, but long-term rates rise due to more bonds and higher risk, a bear steepener. Plus, Trump's clashes with the Fed made policy untrustworthy. The cuts didn't stabilize bonds, just boosted anxiety. Ironically, Trump posted yesterday, stocks fell because of uncertainty. But he's the biggest source of that uncertainty. Data tells the story. UK 30-year yield hits 5.69% 2006 high. German a Dutch long-term yields back to 2011 levels. U.S. 30-year yield nearly hit 5%. Fiscal, supply-demand, and rate crises are blowing up at once. Worst of all, it's not one country, it's global. France, UK, US, Japan, no major economy is safe. Bonds, once the safest haven, are now the biggest risk. You might think, I don't own bonds, this doesn't affect me. Wrong. Next, I'll explain how the stock bond sell-off hurts your stocks and funds, especially if you hold tech or new energy funds. Don't miss this. The truth about stock bond sell-off. The financial system is shaking. Many think falling bonds mean rising stocks, but both are dropping. Why? It's not just money shifting. The financial system stability is at risk for key issues. 1. Broken interest rate anchor. Tech growth stock valuations rely on the discount rate model. Future profits current value. With US 30-year yields near 5%, future cash flows are worth less. New energy stocks with high valuations are getting sold off. 2. Skyrocketing borrowing costs. Real-world borrowing is pricier. Real estate and infrastructure, bond-dependent, see financing rates up by multiple percentage points. Profits are cut in half, so stocks fall. 3. Investors pulling out. Normally, bond money moves to stocks, but now, with debt chaos, political instability, and policy uncertainty, investors choose gold or cash over stocks. No buyers equals falling stocks. 4. Spreading panic. When no asset feels safe, panic grows. Media covers the bond storm. September curse fuels fears. More selling equals more drops. Gold, silver surges are panic's byproduct. This isn't just bond volatility. It's a cross-market chain reaction. Bond yields are dragging stocks, Forex, and commodities into the storm, hence S&P 500, Euro Stoxx 50 falls, gold, silver rises. History lesson. Stock bond sell-offs warned of 2000 dot-com bubbles and 2008 crisis. This time, the trigger is bonds. No one knows if a new crisis is coming. Ray Dalio says, the debt crisis may hit in 3 years. But current volatility is a red flag. Yesterday's bond move was a warning. Today's sell-off means the September curse is real. You might ask, is September always this bad? Why this year? Next, I'll break down the September curse, plus the extra risks this year. Why the September curse is worse this year? The September curse isn't a myth to 3 real reasons. 1. Peak bond issuances. Governments to corporations issue lots of bonds in September. U.S. corporate bond issuance may hit $160 billion this September. Too many bonds equals lower prices. 2. Policy landmines. Fed meetings, ECB policy, Boyd moves, and the budget battles all happened in September. Policy uncertainty keeps investors on edge. 3. Self-fulfilling fear. Decades of data make investors think September is risky. Institutions cut positions early, making the drop real. This year is worse minus to extra risks. France's political turmoil, UK's budget gap, US tariff losses, plus Trump's Fed clashes. Past September curses were small dips. This year could be a crisis. Worse, higher long-term yields hurt stocks, corporate borrowing, and consumer confidence, even systemic risks. Societe Generale warns U.S. 30-year yield at 5% is a pause, not a peak. The pressure isn't over. Don't ignore the September curse. It's a real threat. Gold as silver shows money fleeing risk. The sell-off warns the market is more dangerous. 4. Will your assets lose value? Victims versus survivors. What you care most about? Will your stocks, funds or bonds drop? The market will split. Here's who's at risk and who survives. 1-3 high-risk assets, high-debt industries, real estate, and infrastructure. Some REITs have debt ratios over 70%. With you. 30-year yield near 5% and financing rates up to 6%. Profits vanish. Overvalued growth stocks ***. Unprofitable small-cap AI stocks. Their valuations collapse as future cash flows lose value. Repeats of 2000 bubbles. Small or mid-sized banks. Rising rates cause huge unrealized losses on their $4 trillion. Plus long-term treasuries (MBS). A 0.5% yield rise equals hundreds of billions in losses. Deadly for small banks. 2. For assets that survive. Gold and silver. Gold ETFs have $15 billion plus inflows this year. Silver has both safe haven and industrial demand. Outperforms gold in inflationary risk. Energy or resource stocks. Crude oil above $80. Natural gas up 25%. Oil's copper up 30%. Real demand stays. Resources don't vanish like debt. Consumer staples down less than 2% this year. People need food. Daily goods no matter the economy, steady cash flow, low debt. US dollar cash, short-term treasuries, 3-month U.S. yield dropped from 4.35% to 4.15%. More buyers equals lower yields. Short-term treasury ETFs have $40 billion plus inflows. Steady interest beats risk. In short, this sell-off isn't a crasher, it's a filter. High leverage, overvalued assets get weeded out. Hard assets, a steady cash flow wins. A more dangers ahead. Cross-market risks for emerging markets. Markets aren't isolated. Bond stock turmoil will hit Forex and emerging markets next. 1. Forex volatility. Rising long-term rates in Europe, U.S. Japan forced capital reshuffling. Europe and Japan face outflows. Forex swings become the next risk. 3. Are emerging market capital flight. Dollar inflows to the U.S. exposing emerging market debt risks. High debt import-dependent economies get hit hardest. Chain reaction. Developed market bond turmoil. Gives capital outflows, gives emerging market pressures. 4. Fragile global finance. Bonds once a safety net are now a risk source. Post-pandemic high debt makes the system weak. France's crisis. UK's deficit. US. Tariff rulings. Japan's bond yields. All connected via bonds. This isn't just the September curse. It's a global financial stress test. Without policy fixes, stock bond sell-offs plus Forex swings plus emerging market pressures could become normal. Closing. Navigating the storm with Ella. Today's key takeaway. Stop chasing high returns. Find safe assets. September's biggest risk is lost confidence. The smart move is protecting your principal. If this video clarified the market, like and save it. Subscribe if you haven't. I post daily on global financial trends. Next video, how to invest in gold, silver ETF versus physical and top resilient consumer staples. Comment below. Do you hold stocks, funds, or cash? Which asset worries you most? Let's help each other avoid losses. Follow Ella to 5 minutes a day to understand global finance and make your investments lose less, earn more.